Have you noticed something strange happening in the background of global economics? While media outlets obsess over interest rate decisions and stock market swings, there's a massive transformation underway that almost nobody is discussing. And what makes this even more unsettling is that by the time most people realize what's happening, it'll already be too late to adapt. I'm talking about a calculated pivot in how economic dominance actually works in the 21st century. This isn't about military might or diplomatic agreements anymore. We're witnessing a fundamental reimagining of where true power comes from, and the strategy being deployed is so methodical, so patient, that it's virtually invisible to anyone not paying extremely close attention. Before we go further, let me be crystal clear about something. Everything I am presenting today is based on verifiable market data, publicly available trade information, and documented economic patterns. This isn't sensationalism or unfounded speculation. These are observable trends that have profound implications for anyone holding wealth in traditional forms. So stay with me, because understanding this shift could fundamentally change how you view your financial security over the coming years. Here's the reality that's emerging. The nations positioning themselves to control tangible physical commodities, the actual materials that enable modern technology, are building leverage that traditional financial instruments simply cannot match. Think about what powers contemporary civilization. Your smartphone contains dozens of specialized elements. Solar installations require specific conductive materials. Electric vehicle batteries depend on particular metal compositions. Advanced manufacturing, medical technology, aerospace systems, all of these sectors are built on foundations of specific physical resources. And here's where the story gets fascinating. While developed economies spent the last 2 decades perfecting financial derivatives and digital trading systems, certain other nations were quietly establishing control over the supply chains for these irreplaceable materials. We're seeing systematic acquisition of mining operations across continents, strategic investments in processing facilities that transform raw ores into usable industrial inputs, long-term contracts locking in supply agreements decades into the future. This is comprehensive industrial planning operating on timescales that quarterly focused Western businesses simply don't work with. Consider the strategic brilliance of this approach. If you control the materials, you effectively control who manufactures what products. If you control manufacturing capacity, you influence global pricing structures. If you control prices, you exert pressure on entire national economies. The logic is straightforward, even elegant. And we're not talking about 1 or 2 metals. This extends across nearly the entire spectrum of industrially critical elements. Materials essential for catalytic systems, components vital for electronics manufacturing, elements required for battery technology, resources needed for renewable energy infrastructure, materials necessary for defense applications. But here's the layer that most analysis completely misses. Every transaction acquiring these physical resources represents a conversion out of paper currency into tangible assets with genuine industrial utility. Think about the strategic implications. Over decades of running trade surpluses, certain economies accumulated enormous reserves of foreign currency, particularly dollars. Now, there's a methodical process of exchanging those paper reserves for materials that have inherent value in manufacturing and technology. This isn't random commodity speculation. This is strategic repositioning of wealth from financial instruments into the literal building blocks of industrial capacity. And it's happening at a scale that's genuinely difficult to comprehend until you examine the cumulative numbers. When you hold currency, you're trusting in the fiscal discipline of whichever government issues that currency. When you hold industrial metals and rare elements, you possess something with intrinsic utility that global industries must have to function. The difference in long-term strategic value is profound. Recent trade policy shifts have actually intensified this trend in unexpected ways. As commercial exchanges between major economies have contracted, fewer dollars are flowing through traditional channels. The response hasn't been economic panic. It's been acceleration of the very strategies I'm describing. Existing currency reserves are being deployed faster to acquire resources. Alternative trading systems are being established that bypass traditional financial infrastructure entirely. Let me illustrate this entire phenomenon with one specific example that demonstrates the psychology at work. What is currently happening in silver markets? Silver has experienced extraordinary price appreciation recently. We're seeing values that have roughly doubled within a single year. That's not normal commodity behavior. That's a fundamental supply-demand imbalance creating severe market stress. The classification of silver has evolved. It's no longer viewed primarily as a monetary metal or investment vehicle. Governments now categorize it as strategically critical infrastructure material. Why? Because modern semiconductor fabrication requires it. Large-scale solar deployment needs it. Military systems depend on it. Advanced aerospace applications use it extensively. Here's the supply problem. Mining output is not expanding fast enough to meet exploding demand from multiple competing industrial sectors simultaneously. Basic economics predicts rising prices, and that's precisely what we're observing. But the truly revealing aspect is what's happening in certain major markets, particularly in Asia. Investors there have recognized something about how commodity markets actually function. In paper trading systems, futures contracts, exchange-traded funds, there can be far more claims on physical metal than actual inventory available for delivery. Some estimates suggest ratios exceeding 100 paper claims for every real ounce. Once you understand that structural reality, the rational response becomes obvious. If you want genuine exposure to silver, you need physical possession. You cannot rely on paper promises when the underlying ratio is potentially that extreme. This recognition has triggered unprecedented demand for physical metal, not synthetic exposure through financial products, but actual bars and coins. The demand has become so intense that legitimate shortages are developing in major markets. Investment vehicles are becoming massively oversubscribed. In some cases, investors are paying premiums of 60% above the net asset value just to gain access to silver exposure through these funds. Let me emphasize this. People are willingly paying $160 for every $100 of actual silver value. Everything shared here is strictly for educational and informational purposes only. This is not financial advice, and I'm not a licensed financial advisor. You must conduct your own thorough research and consult with qualified professionals before making any investment or financial decisions. Financial markets are inherently unpredictable, and past performance never guarantees future results. Now, that 60% premium is obviously unsustainable and extremely risky. When premiums collapse, which they inevitably do, investors face catastrophic losses even if underlying prices stay flat. That's dangerous speculation by any measure. But what this behavior reveals is critically important. It demonstrates that physical supply is so constrained that people cannot acquire material through normal channels at reasonable prices. And it shows genuine fear that future availability will become even more restricted, regardless of price. Price differentials between markets tell the same story. Silver is trading roughly 10% higher in certain Asian markets compared to international benchmarks. Normally, such arbitrage opportunities would be instantly exploited by traders moving metal from low price to high price regions until prices equalized. The persistence of this gap indicates supply constraints so severe that normal market mechanisms have broken down. Let me be balanced here. What we're seeing in these silver markets has absolutely become speculative mania. Mania cannot sustain itself indefinitely. There's significant probability of sharp corrections. Some corrective selling is already occurring as I record this. However, and this is crucial, beneath the speculation exists a genuine fundamental story. Industrial users and strategic investors are securing massive quantities because they legitimately understand silver is importance for technology and manufacturing infrastructure. This isn't purely about speculation. It's about securing access to a material viewed as strategically essential. And here's the critical insight. Silver is merely one visible example of a much larger phenomenon playing out simultaneously across numerous industrial metals and critical materials. The same acquisition dynamics are occurring with materials needed for electrical infrastructure, battery production systems, metallurgical applications, high-strength alloys, semiconductor manufacturing, fiber optic systems, touchscreen technology. The list extends across dozens of elements most people have never heard of, but which modern civilization absolutely depends on. This represents strategic resource competition happening in real time at unprecedented peacetime scale. And most observers remain completely unaware because it's not dramatic. There are no explosions or emergency summits, just patient, systematic acquisition, month after month, year after year. Now let's connect this to broader monetary dynamics, because there's another major factor that will significantly accelerate pressure on the dollar throughout 2026, Japan. The Bank of Japan has begun raising interest rates and clearly signaled more increases are coming. Most people don't understand why this matters or how it connects to everything else we've discussed. Despite rate hikes, the yen continues weakening against major currencies. This creates severe problems because it makes all imports more expensive, directly feeding domestic inflation. The central bank is now forced into increasingly aggressive action to defend currency stability. It's become their absolute top priority. But here's their constraint. Japan carries government debt approaching 250% of GDP, among the highest in the developed world. To keep hiking rates aggressively without causing debt service costs to explode, they need to generate cash from somewhere. The only realistic source is selling foreign assets, specifically massive holdings of U.S. Treasury securities. Japan holds over $1 trillion in U.S. government debt. If they begin unwinding even portions of that position to fund monetary policy and currency defense, it creates enormous pressure on U.S. bond markets and, by extension, the dollar. There's another mechanism at play, the unwinding of yen carry trades. For over a decade, This has been among the largest trades in global finance. Investors borrow yen at extremely low rates, convert to dollars, and buy higher yielding U.S. assets, pocketing the interest differential. This trade has funneled enormous capital into U.S. markets, supporting asset prices and keeping yields lower, but it only works when Japanese rates stay very low and the yen stays weak or stable. As Japanese rates rise, the trade fundamentals deteriorate rapidly. The interest gap narrows, reducing profit potential. More critically, the risk profile changes dramatically. If the yen appreciates significantly, you must repay yen-denominated loans using a much stronger currency. Your debt in dollar terms just increased substantially. Meanwhile, U.S. assets you purchased might be declining. You're losing on both sides simultaneously. Every sophisticated fund manager understands this risk has become extreme. The prudent move is to exit. And that's exactly what we're observing begin. This carry trade will continue unwinding as Japanese rates climb higher. This isn't speculation, it's financial logic. When carry trades unwind, it means capital flowing out of U.S. assets, selling pressure on U.S. bonds and reduced dollar demand, happening simultaneously with all the other factors we've discussed. Step back and see the full pattern. Major economies are systematically converting massive currency reserves into industrial metals and critical materials while building alternative trade systems. The dollar is already in a structural down cycle that historically lasts 5 years or more. Japan is preparing to potentially sell hundreds of billions in treasuries, while carry trades supporting U.S. asset prices for over a decade begin unwinding. Global trade patterns are shifting away from dollar-denominated transactions. These aren't isolated events you can analyze separately. They are interconnected parts of a fundamental shift in how the global financial system operates and where economic power resides. The effects don't just add, they multiply. They create feedback loops where each factor amplifies the others. The United States will likely need to create substantial new currency to fund its own belated strategic stockpiling of critical materials. That's additional dollar supply entering the system. Both superpowers are now competing for the same finite physical resources, and both strategies create sustained downward pressure on dollar value. We're watching a fundamental shift in how wealth is stored and how economic power is projected. Paper currencies are steadily losing relative value while physical resources and strategic materials gain importance. The year 2026 is setting up for extraordinary volatility for dollar holders and anyone with significant wealth in dollar-based assets. The reserve currency faces multiple severe structural headwinds hitting simultaneously. This is not like previous cycles with one primary cause. There are 4 or 5 major factors working in the same direction at once. Most mainstream analysts dramatically underestimate how these factors multiply when they converge rather than simply adding together. Wall Street tends to analyze each issue in isolation. Trade policy in one box, monetary policy in another, geopolitical competition in a third. But complex systems don't work that way. Everything affects everything else. The interactions and feedback loops are where real impacts occur. This isn't just another market cycle that reverses when central banks adjust policy or trade agreements get signed. This is a generational shift in the structure of the global financial system. The framework dominating since World War II is being challenged not by military invasion, but by patient strategic economic positioning. If you're holding significant wealth in dollars or dollar-denominated assets, the assumptions and strategies that worked for the past 50 years might not work for the next 50. It means understanding that tangible resources and strategic materials are likely becoming more valuable over time relative to paper currencies. It means recognizing we're entering an extended period of monetary instability where traditional safe havens might not perform as historically expected. It means thinking carefully about diversification, not just across different stocks or bonds, but across entirely different asset classes and potentially different currencies. It means understanding that the rules are changing and the change is being driven by forces much larger than any single central bank or government can control. So let me know in the comments what you think. Will systematic industrial metals acquisition ultimately reshape global economic power dynamics? Can the dollar maintain its reserve status through this massive transition? Or are we watching the beginning of a shift to a multipolar currency system? How are you personally thinking about positioning your finances for what could be a turbulent 5 to 10 years ahead? I genuinely want your perspective because these are literally the most important economic and financial questions of our time. The decisions being made right now by governments, central banks, and individual investors will echo for decades. Stay informed, stay analytical, and remember that knowledge and understanding are your best defense during periods of major uncertainty and transition. If you found this analysis valuable, share it with others who need to understand what's happening beneath headline noise. Make sure you are subscribed because I constantly track these structural trends and bring you analysis that mainstream financial media either completely misses or deliberately won't discuss. I'm not beholden to advertisers or corporate sponsors. I present evidence-based research as I see it. Thanks for watching and engaging.